Hello, everyone. This is the Investor's Guide to Joy podcast, and my name is Paul Graham. We are going to go through a number of different opportunities for you as an individual to understand more about the tax code, your investments, and ultimately what that means for your taxes and the income that you generate. Oftentimes with CPA and accounting type professionals, we don't get into the mindset of a chief financial officer type perspective. So Tino and I are going to go through a lot of questions related to that and investing. One of the biggest takeaways from today is we're going to go through when and how limited partners may not able to actually deduct against your active income for the investment. This is imperative because every just about investment that I see opportunity is going to say that you can offset your taxes. This is not always the case. And so we also go through the two things that you need to do if you do have the conversations with these funds or these syndications that are going to give you the passive way to ultimately offset your taxes. If you're a limited partner who's looking to invest to offset your taxes, oil and gas is the best, in my opinion, way to do that. Reason being is that it's the highest depreciation, typically 80 to 100%, and has passive cash flow. It also is, in our case, a way to viably offset your taxes. Keep in mind, not all oil and gas or all real estate opportunities are. And one of the most important reasons of why we go through that on today's podcast. More information will be in the show notes if you're looking to invest in oil and gas for 2024 to offset your taxes. But for now, let's get into the show. So today, Tino Madyara is going to go through a number of items related to businesses, tax savings, investing, and even being a real estate investor himself. Tino, thanks for being here.
Hey, thanks so much for having me on, Paul. Excited to have the conversation.
Yeah, you bet. And I mean, we're in Q4 of 2024. Most business owners are hopefully not ignoring, your emails because now is definitely the time to understand like what has happened in the year. What are we looking forward to next year? What sort of tax saving strategies we should, consider and look at for, really the business owner clients like you have. One thing I wanted to really go into is like, why does there tend to be individuals who are these business owners, they tend to only focus on investments and tax saving strategies for the business and not necessarily themselves. And they tend to not like overlap. So I wanted to give you an opportunity to talk more about what strategies you're seeing that like business owners do and individuals do and see like what, if any, overlap you tend to find with those things.
Well, I would say that there is a lot of overlap. From my perspective, when I'm serving a business, I still view myself as serving the business owner themselves, even though the name that goes on the engagement letter on the tax return, might be Paul Graham LLC. At the end of the day, there's a person behind that business. And so ultimately, those two things do work together hand in hand, especially just working with a lot of pass-through entities, right? To where whatever there may not necessarily be a tax impact on their business. It ends up flowing directly to them. So in that sense, the two do work very well together in terms of thinking from your business side and what you're doing for on the individual side. It ends up all melding together.
Okay. Yeah. It's fascinating to uncover what, options, they have. And I've also found like the difference between 6, 7, and 8-figure business owners. They also either know or, do some of these either planning services or, financial, just like understanding almost, or even by golly, just like recognizing that, it is the end of the year. You should be understanding like what your tax implications are. So that way you could still like advantage of things like, within this year. Talk to me more about, because you do, some CFO services, which is, unique in some ways, considering your background, like what have you found that businesses are, experiencing and maybe even like avoiding?
I would say for the most part, your smaller business owners, let's talk probably 500 or sub $500,000 businesses. The focus is very much on the taxes, and that there's really two sides to think of it. Like firstly, like what I said is like most of those businesses are pass-through entities, and we always hear about when you're starting a business, don't just build yourself another job. So really within that range where businesses are still kind of within those early stages, or even if it's a mature business that's within that income range, a lot of the time it is very much focused on the owner. So it's an owner-operated entity, not necessarily a large staff. So really for people at that size, normally they just thinking about their finances within the scope of their taxes. So a lot of people may not necessarily keep good financial records. It's really an afterthought that, once we're coming up to the end of the year, that's when people start to, let me start, putting together my financials. And a lot of the times too, some people, it's an after the end of the year activity that they start to engage in when they start thinking about their taxes. And so at that point, now you're putting together a record of how you did for the previous year. And, for the more mature businesses, you understand that there's a lot of good financial information that you have at your disposal. And let's put that information together throughout the year to be able to make some business decisions around it. And that was really what led me to now starting to focus more on the fractional CFO services. Is that, just as a tax professional, you'll find a lot of people, they're coming to me strictly looking for tax savings. And that's great that we can definitely do that. But there needs to be a little bit more of a forward-looking element to it. And in order to be looking forward, you need to know what's happening right now. And, you take your track record of what's happening in the past, what's happening right now, what are the future conditions that you're expecting? And then we can start to make projections for the future. And so very much for taxes, absolutely. As you're working through like your day-to-day, you have transactions going on, maybe some acquisitions, just things of that nature. You need to be talking to your professional throughout the year. And the larger companies I work with are a lot better at doing that and having like a dedicated team throughout the year to make sure that everything is going where we need it to go. And if it's not, what are we doing about it to correct it?
Sure. And what are you defining as like larger company? Are we talking like 7, 8 figure?
Yeah, for sure. 7 figures, like once around like $2 million and up. So I work with some construction companies that will have like, just because of the nature of the type of work that they do, like those revenues will be higher, right? You start getting into 8-figure businesses. And at that point, you definitely want someone watching over this. And more than just an external CPA, I start to advise people at that point, you have someone internal that's at least taking care of the day-to-day, just day-to-day like administration, right? Just your accounts payable, bills need to be paid, like revenue needs to be collected. So yeah.
Yeah. Okay. One thing I'd love to learn is like, what's like your biggest success story? Like, what would you say is like the most that you've been able to, save or create in terms of value, like for a company? And then what size, company was it?
Well, when you say value, that's always a tough one to nail down, right? Because there is different people value different things. And like I said, so sometimes like from a tax perspective, right, the biggest thing they're looking for there is like, let's decrease my tax liability as much as I can. Other people, it might just be because I've also done like some services where we're helping with business acquisitions. And so I would say like one example was looking at helping someone with a transaction with trying to acquire a business and whatever. And so let me back up a little bit. Through the process of that, right, we'll do a quality of earnings review just to make sure that whatever the seller is presenting as, these are their numbers, let's make sure that actually has some legs to it and they're not pulling numbers out of thin air. So you go through that information and then based off of that, obviously is what you determine your value based off of the net operating income of the business. So I had an instance where a guy was going to buy a company and it was going to be at around, I think the multiple was sitting somewhere like four and a half multiple of seller discretionary earnings based off of the information that they had. And then after we do our quality of earnings review, you start looking at those numbers and there's a lot, you have to take off a lot more expenses than they're reflecting to get down to the actual number. And so really at that multiple, with this new information, this new seller discretionary earnings number, the selling price dropped significantly, probably by about like $500,000 of what they were anticipating purchasing. So I would say like that was a success story in that there's no actual like dollars there are no tangible dollars that they can see where this amount was decreased from their tax liability, but potentially avoiding overpaying for a business.
That's certainly fair. What would you say is something that you wish like more business owners knew as it relates to taxes?
Specifically on taxes? Well,
Yeah, I'd say let's start with taxes first.
yeah, so I would say people within the real estate industry, people love forming partnerships. And there's a good reason for that because they're the most flexible entity that you can have in terms of the restrictions of the tax guidance. And I find people maybe doing some things that are too sophisticated for what they're actually trying to accomplish. I'll give you an example is people form a partnership and they'll have like a different capital allocation ratios, different profit allocations, different loss allocations. And you start to get pretty deep into the tax code when you start doing things like that. And I'll talk about like GPs, for example, where we all know about if you're a real estate professional and being able to take some losses against your to be able to decrease your income. That's the biggest way that real estate professionals biggest advantage of their on the tax side. And now, and we all know that you're supposed to be actively participating within this real estate. And, there's some other parts of the tax code that we can dive into to where we can straighten out what all the actual rules are. Sure. But you'll find some people maybe improperly assuming what type of depreciation they can take. So they may think that they can take all these extra losses, but they may not necessarily be able to based off of either their participation their material participation, or specifically the amount of capital they've invested in there, right? So there's some rules to where depending on your basis, you can't start to take like losses in excess of that basis. So you might project that you're going to be able to have like a $500,000 loss at the end of it, where you don't have that much basis within that property. So partnership taxation for sure is the biggest area. And what I was alluding to earlier is like you'll then start seeing people doing things like this on maybe it's a single family residence, a $200,000 house, and now you're putting in some of these complicated partnership formation in place. And from my perspective, right, I'm going to have to follow the tax code regardless of whether it's a $200,000 property or if it's a $2 million property. And just the complexity that adds to your tax return to where maybe there's only about a $4,000 benefit, all things considered. Yet you've put all these extra complicated things and there's carries in there and so people will make it more complicated than it needs to be, where you might just be better off just going with a more simple structure and, just play, if you're playing with smaller amounts, doing some of those extra things may not benefit the dollar amount that you benefit on there might not be as great as what you would assume. And just because you've seen that work well on a larger entity may not necessarily translate for smaller properties.
Yeah, that's certainly fair. And it's sometimes tough to judge like when to use what strategies, but ultimately, it's talking to the professionals to see what they recommend and what options are, what have you. You're talking a little bit about, syndicators and, the general partnerships. What would you say is like a big, like just like unexpected thing or maybe like a myth or something like that you kind of hear within within kind of that space?
So I would say more on the LP side. So syndicators will go out and they'll advertise depreciation as one of the benefits for their investors. And like as a passive investor, you can't take those losses against your active income. So this may be marketed to people as, hey, there are all these great tax savings, but it all depends on the individual as to whether they can actually benefit from those tax savings. So if you have a lot of other passive income that you need to offset, then like by all means, by doing a syndication, that'd be a great way if there's enough depreciation there for you to take to offset that. But a big misconception is that someone will go out raising capital and they're pitching tax savings, not knowing what the person's tax situation is. And I'm then working with the LPs where they're expecting to be able to take these huge deductions on their tax returns, but they can't because they haven't met all the criteria that's to be able to take that deduction.
Okay. Yeah. I mean, that's definitely an unfortunate thing. And it's one of those like, well, you can, right? I mean, by, fundraising in oil and gas, you can take up to 100%, but there are some, stipulations within that. People need those stipulations just for those who are curious are in terms of like amount invested. And then it also depends on the project. We had one project that had 83 percent depreciation, right? Which is more than real estate typically. But that doesn't mean it's, guaranteed 100%, but it is, up to 100. And there's a number of different small factors, at least within the, type. I mean, do cost segregation studies get passed, to everyone, or is that the same thing of like, it just depends on the individual's,
Yeah, so all of that will get passed through to the individuals, but it might just get suspended on there. So it'll just be sitting as a suspended loss that you have to take in a future year. So either when that property gets sold, you get to take that, so you're not paying any capital gains taxes, right? You can use that to offset it. And then we can go into a whole nother discussion about recapture as well, that people aren't always aware of that coming back to bite them. But no, you absolutely, it absolutely does get allocated to everyone. But again, it's like, do you have the ability to actually take that loss? Like if you're like 100% of the time, if you're just passively investing in an LP syndication, you cannot turn around and just deduct that against your W-2 income. And as educated as I think the investing public is, I'm still astounded at the amount of times that people are not aware of how that actually works.
Yeah, it's as I've raised capital, I've been in more of these circles, and yeah, it's definitely fascinating, and it's some ways tough to be like, hey, like you aren't actually doing what you think you're doing, or it's that in some ways we are competition, but also not. Like, oil and gas is an incredible way for, tax saving type year. It can also be used as like a primary investment vehicle. My personal viewpoint is more of like, do the equity plays, right? Real estate, PE, things like that, and then use oil and gas as a tax saving. Granted, there's certain types of oil and gas that is advantageous for tax savings with working interest, not just, well, I mean, you still get the tax savings, I guess, for, poking the hole in the ground, if you will, right? However, you either get cash flow or you get nothing. So that would be challenging. But yeah, knowing which type of oil and gas is beneficial, just to kind of what you're saying too, of like, within real estate, like what, type of investment, and then also based on your, situation. So it really seems like, having a tax professional who is not only knowledgeable, but is also then doing like reviews and such, with you is going to be imperative. Otherwise, it just seems like it's going to be a, hey, I did this. And it's like, well, you couldn't or shouldn't, or, you're not going to get this sort of thing. And it's like, well, how do I get, my money? You're just all these kind of like issues.
Yeah. And then, so sorry to cut you off. I was just going to say, like, that's where the importance is of meeting with your tax professional or whoever you're using on a more frequent basis, right? And have those conversations before you make the investment versus now coming, if I'm getting all this information, in February of 25, and you're thinking that you have these huge tax savings coming, if we'd had that conversation in August or whenever it is that the investment was made, we make those projections out and see, okay, if you do X, Y, Z, you can then benefit from this by, and here's the list of criteria of things that you need to do to actually be able to benefit from it. So, and I get it, just because, we're in the chat GPT age and information is readily available. And sometimes just knowing what is the right question to ask, because you can, right, you can, there's confirmation bias. So you can find the answer that you're looking for just by going out and doing some research. But there's a lot of other considerations to take into account too.
Yeah, let's go down the path of, talking about, recapture. I mean, specifically for, those LPs from like a residential side, though, first, as we iron that out, I mean, really, that's just going to be the rule of 2 out of 5, right? Or it's going to be, some sort of 1031 exchange if it was, turned into an investment property, or it's just going to be, you sell it and you kind of have, the capital gains. Is there anything to add, at least on kind of the residential typical like homeowner side, before we get, kind of more complicated and bigger?
I mean, it would work the exact same way, whether it's a residential or it's a commercial property on your recapture. Like if you've done a cost segregation on it, you're taking depreciation, which you're required to take depreciation. Then when that project goes to sell, or when you're doing a 1031, right? It's basically like if you've taken these deductions against it at an ordinary rate, and now you're going to sell, you can't then get that same benefit at a capital gains rate. So they want to capture that at the ordinary income rate to be able to make sure that, whatever taxes that you're paying are that you're not underpaying when that property is sold.
Yeah. When they're specifically in syndications, let's go multifamily, because multifamily is like the biggest and obviously then most invest in it. The biggest being in terms of like market share. What should people be considering? What should investors be considering like before they make the investment, while they're doing the investment, or just have it right? And then also once, the investment is disposed of and ultimately sold as well.
Beforehand, I think that's just due diligence that you need to make sure that you're doing on the actual investment itself. Look at what returns are being proposed, and it'll say, depending on how it's presented, right? They would tell you if you should expect a lot of that return on the back end, if they're thinking, okay, this is more an equity play, to where we're going in to fix this thing up, and there's going to be there'll be a big capital event at the end of it, to where that's where you get the majority of your return. Or is it something where you'll be expecting to get more incremental returns, like higher returns, like throughout, because it'll just be presented as like as what your final returns are for the project, right? But understanding like where what exactly that return is going to look like. Those are some good questions to be asking ahead of time, to make sure you know what you're getting yourself into. And then like once you're in there, you're in there. So a lot of the pain is taken care of, ahead of time, right? Because we all know more recently because of what interest rates are doing, there may be some additional capital calls that are required in there. And that's, I don't know what else there is to do, like from the investor standpoint at that point, right? You kind of got to decide, and it's really dependent on the GPs, on what avenue they're taking, on how to, whether they're refining or you're selling, or what position you're going to be in. And then when it comes time to sell, when that money is coming in, we always try and like time that to be able to, like, if you're expecting that there's a sale that's happening this year, and try and project out as best we can what we think those returns are going to be, how much your percentage ownership is going to result, what type of gain you're expecting from that, and then try to do start looking at some planning that we can do ahead of time, to make sure that you can counter that. Either you're going like to go reinvest in something else, like that's probably the most common. But just looking, it really depends on the individual as to what else they have within their portfolio. Do they have a business or investments, to make sure we can do what we can to minimize that return?
Yeah, you bet. What would you say is like a reasonable timeline to have that, kind of proactive conversation? Like, are we talking like 2 days, 2 months?
I would say months for sure, because
Beginning makes sense, right? Hey, if we think, they're going to sell this year, so be it. But definitely every D operates differently. And some, at least that I've talked to on the back channels, like every other week, they're like, oh man, I should like maybe sell it. And it's like, okay, anyways, I'm just kind of crazy, but yeah.
Yeah, well, yeah. And yeah, I would expect that the GPs have enough communication with their investor base, to where you're keeping up to date with what's happening within your investment. So there should be at least at a minimal, quarterly reporting that's happening, so they can see the performance, but periodic updates as well as to what's going on in the market. If people are spooked, for the most part, I see that there's at least some sort of communication where they know. Or if it was supposed to be a 3-year hold, and everyone knows that we're in year 3, something's supposed to happen this year. We're expecting a refi, but now it doesn't look like this could happen. So there will be some sort of communication, and you'll be aware of what's coming down the pike, and having that conversation with your tax professional to prepare for that is important.
Yeah. What would maybe be like the 1 or 2 piece of advice you would tell people on like finding the best tax professional, like for them, and just in general?
Well, always ask for the person's experience. I think there's a tendency within our industry of, CPA just thinking they know it all. I'm very clear when there's stuff that's outside of my scope. Like, I will tell you, like in international taxation, for example, if you have dealings outside of the US, I will happily send you to someone else that can better serve you, because you just need experience in doing those things. So making sure that your professional has some kind of track record and has been working with clients similar to you. And you can start asking them like very specific questions too, right? like if you like just example what we're talking about right now, if you tell them, hey, there's a liquidity event that's happening, so we're expecting XYZ, what would you recommend, or what have you done with others in these situations? So as specific as you can get, because if you just ask them, do they work with real estate investors, 99% of CPAs are going to say yes. But the more specific you can get about your situation and ask those questions to them, that'll help you determine if that's the right professional for you.
Sure. Yeah. One thing I'd also like to expand on is like you're a real estate investor yourself, which I tend not find as like specific. So can you talk more about what your journey has been? What do you have now? And then what you also like and don't like in terms of investing, at least for, yourself?
Yeah, so real estate investor is a generous title to give myself. I have two single family properties that are rentals, just long-term rentals that we have, and so like my passionate love for real estate is like when I was working, before I started my firm, I worked for a large public accounting firm, and one of our big clients was a big like real estate investing company. They had I think 18 billion in assets under management at that time. So, and I, when I started working professionally, it just seems like it was just a different world, right? I think as accountants, sometimes we just become numb to what numbers mean. So you'll see these big investors that going out, they bought a $50 million property, $100 million property. And it just seems like an outside world where this is the stuff that the super wealthy are doing. But then when you start to break it down and realize, no, people are doing this even on a smaller scale, like that's when I decided, and I'm looking at these big funds like doing amazing things in real estate, and I decided, let me try and participate within this instead of just being a bystander. And so that's when we purchased our properties, and then like after the second purchase, then you run out of capital, and you're like, okay, where am I going to get the down payment to make this next purchase? And so that was really where it kind of fizzled out. But I do have plans to keep investing in the future. I've entertained some syndications in the past and never actually come to it to where we've pulled the trigger on it. But yeah, so so that's my investment journey. And so a lot of stuff that I will do like for myself, like personally, I try to think from my perspective as an investor, what would I want? What would I want happening for me, my taxes? What would I want from my tax professional? And I sit in that seat first, and then that's how I try and serve my clients.
Sure. Yeah. What type of, syndication opportunities have you, looked in the past?
There were some multifamilies that were. I'm in the San Antonio, Texas area, so there's some multifamily syndications where they're kind of going through like a capital raise, and we looked through it and you just weren't ready to pull the trigger on it. The returns seemed so, and so this was after we'd made our first purchase of our first rental property, and we were trying to decide, should we go and just buy another single family property, or should we just go the syndication route? And so we ended up just buying another single family property. And in hindsight, that was probably the best thing to do, just because the timeline of it was kind of at 21, 22, and like the interest rates were starting to do this number. So I just imagine that with some of that debt coming due, I'm not sure how those properties are actually performing right now. Whereas like in my single family, I'm sit and hold, let's hold tight. There's rents coming in. So I'm okay. I don't have to worry about a refi or what the markets are actually doing.
Yeah. I mean, fixed debt is definitely different, right?
Yeah.
And it's definitely one of I have a whole kind of course and education and even soapbox on this of just like as investors, like scale different stages of income, right? Like how they should go about thinking about finance, the types of things they, should or could invest in, but also the nuances, right? I kind of mentioned some oil and gas stuff, but, to your point, I'm just a bigger advocate on, fixed debt for these types of properties because there's just one less factor, right? Like we can't predict the future. And ultimately I've just seen within syndicators, it's like, oh yeah, we're going to be here. And then the appreciation is going to go like this and the rent's going to go like this. And all the people are going to move are going to go like this and everything just keeps going up, up and right. And, there's too many, factors to be at play and I've heard of even operators, lose properties, not because of their, operation, experience or what have you, just like the market, the debt, that, there's just all these things and they're, going for pennies on the dollar, and investors are then kind of hitting that. So certainly a good thing to keep in mind as people are growing. Are those some of the nuances that could really keep them from investing, and then to your point, from investing or to investing, and then with that again, what was that then outcome? So yeah, it seems like you made a good decision, especially 21, 22. Yeah, like that was a good Texas appreciation ride. At least it was for me.
Yep.
And so I'm looking at taking that equity and then investing that. So it's kind of a 1-2 punch. But no, that's great. What other things would you say from like the LP or GP side have we maybe not covered that you think people should like absolutely know as it relates to investing?
I mean, we could go down like a couple of rabbit holes, but I mean, I think just for the most part, it's just like things are unexpected. We always say like past performance is not indicative of future returns. Mm-hmm. And I think for a lot of us, I was in college when like the 08, 09, the great financial recession happened. And so it didn't really, I didn't really fully experience what that meant. I mean, the extent of it was, I had a finance class where we had kind of managing a portfolio, and, we meet weekly to make investment decisions, and just the market was just doing this number the entire time. So, but it was just, it's fake money. But so really this downturn here is the first time in like, at least like my adult life, seeing an actual downturn and those real estate returns not just be up and to the right. So really the important thing is to do just more due diligence about what exactly you're getting into. And I think this has been a good reminder to people that it's not always up and to the right, and there is some risk associated with it. But I understand the challenge, like that there is a challenge for LPs to be able to properly do that evaluation, because you're really only subject to whatever information that the GP is providing you, right? And so I think at that stage, it's comparing, right? Seeing like what other if it's a fund or a syndication that you're getting into, what are they doing? Are there similar properties that compare? Are there two properties that are maybe closely located and they're both their projections look very different? And it is a challenge because it's just not like the public stock market where you can just clearly see like what's been happening. And, there are a lot of analysts that can help you come to that type of conclusion. So it's just a difficult time for people right now. And it's just hard to know like what you're getting into.
Yeah, no, certainly. That's good perspective. So this is definitely like the investor's guide to joy, and appreciate, the insights you gave so that people aren't kind of left out in the dust and doing deals that don't really align with them, or not, being within their taxes, or even just, learning what that could be. What would you say you would put in this guide in terms of like, mindset, a quote, some, sort of mantra that you think really resonates with you and your journey?
I think everyone needs to understand what lane they're going to be in, and just try find what is true to you. If you're going to go down the business route as your way to generate wealth, or it's going to be through real estate, just find what aligns with you and then pursue that, instead of trying to copy what you see others doing. I think that's where we end up getting in trouble sometimes, is because something is working for someone else, then it's automatically going to work for me.
Sure.
I think the biggest thing to, get an understanding of who you are, what matters to you most, what type of life you want to live. And then from there, make the determination of what you want your wealth journey to look like.
Okay. Yeah, I would definitely agree. It's the idea of like understanding about, yourself, where you're going, what you want. I have a 3-year vision template that people can download and fill to understand where they, want to go, and those kind of questions. Because otherwise, we're just doing things that may not align with us. And we may not know that until we get there. And some of it's certainly like, growing and trying, certainly. But that's a very good perspective, especially from what you said from your experience. So Tino, thanks so much for being on, sharing your insight. And I'll go ahead and, link in the show notes where people can find you. But, I had the chance to learn a couple of things today. So thanks for sharing.
Thank you so much, Paul. I appreciate the time.
Yeah, you bet. Hey, one last thing before you go. I wanted to share my mission while on this earth. And it's to help educate investors about different opportunities, share mindset tips on how to change our perspective and different things to really experience more joy in our lives. If this resonates with you at all and you enjoyed this episode, please share it with friends and others to help grow the community around the Investor's Guide to Joy. Leaving a 5-star review also helps grow the show and get connected to more people and share our experiences along the way. Thanks so much for joining, and can't wait for you to listen to the next episode.